Really appreciate the opportunity to join. Thanks for including me. I'm fortunate to have had over 15 years of collaboration with BAFT. In one sense or another, been member of the Trade Finance Committee, the Trade Finance Compliance Committee, and really appreciate the BAFT efforts to sort of lead with these conversations, particularly around risk mitigation and innovation. I also chair the ITFA, International Trade and Forfeiting Association Financial Crime Compliance Initiative, where we collaborate very closely with BAFT on emerging trends in mitigating and preventing and detecting financial crime risk. So really happy to be here today. I think there's probably two key themes, two key use cases we'll talk about from a stablecoin perspective around trade finance. One is payments. So at the end of the day, trade finance in whatever form ultimately involves a pass of value from a buyer to a supplier, from an importer to an exporter. And then the second is tokenization around trade finance assets and transactions at a facility level, from an asset management perspective. So I think those are really the two key themes that we're going to talk about from a trade finance and digital asset / stablecoin perspective broadly. I do think it's important to maybe mention a couple of other underlying themes as well as we kick off this discussion. One, blockchain and distributed ledger technology is not new. In fact, has been around since 2009 with the launch of the Bitcoin network. January 2009 was the Genesis block, the first Bitcoin block mined off the chain. So DLT is not new, is well established. I think the other kind of key theme for me is that some of the initial concerns and issues around both the technology and cryptocurrency are less concerning now than they were maybe 5-10 years ago. In a couple of ways, stablecoins have certainly helped to reduce concerns around volatility and unpredictability in the crypto space more broadly, and also from a tech perspective, maybe some of the early promise of blockchain in trade finance, with improvement in time from a letter of credit perspective, with supply chain finance, and the ultimate failure of some of those initiatives. I think the industry has moved on with a recognition that it wasn't necessarily the technology that caused those failures. It was other issues like the challenge in creating a standard across multiple industries and so on and so forth. So I think those are some key themes that we're going to dig into in a bit more detail.
Thanks, Ben. Tiffany, do
Great.
you have any insight on that?
Sure. And thank you, Deepa. Thanks, Ben. Happy to be a part of this event. This is my first BAFT event, so happy to be here. But definitely agree with the use cases that Ben touched on. And then just to really, succinctly put it, I think the intersection between digital assets and trade finance is ultimately just inevitable, right? We've talked about how long this technology has been around. What's the goal of improving these transactions? It's finality, it's speed, it's traceability, and it's safety and security. So even though this technology is relatively new to others, this is just bound to happen because everyone wants their value faster and they want to be able to trust the system. So I think with that, we can probably get into some of the details, but definitely aligned with the group here.
Wonderful, thank you. So what's driving the growing interest in using digital assets, like stable coins or tokenized instruments, within the trade finance ecosystems? Tiffany, what have you seen?
Sure. Yeah. So again, it kind of just ties into why I'm thinking it's inevitable, right? So especially with our customers, we're connected in 90 plus countries. So the cross-border element and looking at this technology as an alternative to complete that, again, quickly and traceable is part of the appeal here, and having basically your digital ledger that is transmitting the information that you and your clients need to have. No market likes uncertainty. So again, we've got some nuances to overcome with the newness of the technology, but having the certainty of having a fully traceable transaction end to end and providing a little bit more trust in the system is what markets always pursue. So that's where I think is driving the interest here.
Great,
Yeah,
thanks. Ben, go ahead, please.
sorry, Deepa. Yeah, fully agree, Tiffany. I think that's exactly right, and I also completely agree with you in terms of the inevitability. I quite liked Bill Winters' comment at the beginning of last week, the CEO of Standard Chartered. He said pretty much all transactions will settle on blockchains eventually, and all money will be digital. Think about what that means: a complete rewiring of the financial system, and I think that's sort of where we're getting to, relatively quickly. Um, I think in terms of benefits, you hit the nail on the head, Tiffany. I think faster, instantaneous transfer of value, irrespective of sovereign borders. I think less expensive. Not a definite there. I think obviously, probably less expensive, but the economies of scale in more traditional payment networks may mean that actually the kind of expense is less of a differentiator in the medium term. But certainly that certainty and reduction of risk, where for me as a sort of documentary trade person, even if it's just an invoice in the open account space, the ability instantaneously to exchange payments and documents representing goods or services is really quite a game changer when it comes to digital assets.
Great, thank you. So, Tiffany, you may have touched on this a little bit already, but how do you see the Genius Act and similar legislation shaping this next phase of digital asset adoption in trade finance?
Yeah, I think it's good, right? I think it's starting to show that there's a little bit more comfort. I don't think it's a magic bullet of any kind. I think it's the first step. Basically, what this legislation is doing is saying that these options for innovation are available. This is something that we will pursue. It's not meant to replace anything overnight. But it also, we're still waiting on some more to come out. We need the Clarity Act. We need also to, at some point, we're going to have a flashpoint where this regulatory arbitrage is going to have to come to a head. Other countries have gone ahead of others. We're a little bit more, behind, I would say, especially in the Hong Kong, Singapore space. And then you've got Mika. So we're going to have to align there at some point and get that clarity around it. But I think it's a positive first step to say, we can come into this space, we can start to experiment and really innovate because just on the comments that Ben quoted earlier, right? It's shaping into a digital economy. This is not going, it's not a trend, right? It's not a fad anymore. This is something that customers around the globe are going to expect.
Great, thank you. Ben, stablecoins are increasingly discussed as tools for cross-border settlement. What practical benefits and risks do you see for their use in documentary trade finance or even receivables financing?
Yeah, sure. I think it's I think it comes to that ability primarily to better align the transfer of value with the exchange of goods and services, and all the concurrent values in terms of transparency, visibility, traceability from a smart contract perspective, audit trail, multiple parties, the irrevocable nature of a block on the chain. Um, I think in addition to that, it's a very natural fit in terms of the technology with the evolution of international rule sets. So
Mhm.
I think using stable coins to settle documentary trade transactions are already a perfect fit with EUCP, for example, um, which promotes electronic trade. Likewise, with the move towards using electronic bills of lading. Um, I think from a legislation and regulation perspective, also there's a very strong correlation. If you look at the Anti-Money Laundering Act of 2020 in the US, which was signed, I think, the final day of the year, right at the end of the first Trump administration, heavy emphasis on the use of technology in mitigating financial crime broadly, and of course in trade finance and the promotion of trade. Likewise, other jurisdictions like the UK Electronic Trade Documents Act. Um, all of these are very kind of clear correlations with the use of digital assets in cross-border trade finance and the transfer of value. I think also kind of more broadly ICC rules, not just EUCP, plus the establishment of control, which I think is a big factor. You mentioned in your question, deeper receivables finance, where there's obviously less documents and data. Whether those documents be PDF versions of paper documents or electronic documents, but certainly mitigating risk, which is one of the key themes of this event, this 2-day event, the ability to detect and prevent fraud around that increased control over the transfer of value with simple practical things like making sure that payment in settlement of a receivables finance transaction goes to the bank rather than the seller, which will mitigate quite a bit of risk in cases like first brands, and some of the cases we've seen elsewhere in the structured receivables finance space.
Thank you so much, Ben. And I'm going to just put my host hat on real quick for a second. For those of you who are listening to this wonderful session, please, if you can, in the chat, just let us know where you're from, so we know that your chat functionality is working for you. And this will make sure we can, you can ask questions and whatnot in the future. Okay, switching hats back. How are financial institutions managing liquidity, volatility, and counterparty risks when settling transactions in stablecoins? Tiffany, do you want to start us off
Yeah.
on that?
Sure, not a problem. I think one of the key things when we're looking at this evolution of how we're going with digital technology, trade finance, et cetera, a lot of your core principles and your core risks, they still apply, right? We're just executing a transaction in a new way, but all of the things that you're on the lookout for exist. They're just manifesting differently, right? So you've got everything's traceable, which means you have more data. Everything's faster, which means your systems have to be more scalable, but you're still applying your same anti-fin crime principles. You just have to have uplifted your systems, uplifted your detection, and be prepared for that. And go with not just what you have, it's new, but apply your core principles. A real key to this is being able to iterate effectively and safely. So as you move into this space, you don't just switch off everything that you already have and switch to everything new. You're going to pilot this, you're going to test it, you're going to iterate it, and then you're going to have things concurrently running and be able to learn from that. So are you solving for, your problem statement correctly? You're not just doing it to do it, you're doing it to solve a client need with that. So basically it's uplifting your core principles, adopting the new technology, and as with everything, right? With speed comes scalability, with speed comes more risk. So you don't want to have so many protocols in there that you're slowing down the payment process and it becomes unattractive. So you need to have a fit for purpose solution when it comes to that fraud detection.
Yeah, no, it's definitely a delicate balancing act, right? Between,
Mm-hmm.
the speed and then the control that you need to mitigate any kind
Right.
of risk. What about, Ben, what about counterparty risks? How are financial institutions managing that in this new age of stablecoins?
Yeah, thanks, Deepa. I think a couple of things. One, completely agree with Tiffany in terms of that balance. I think it's in kind of, I guess, the counterparty more broadly when thinking about digital assets supporting trade finance transactions. Of course, stablecoins have addressed quite a bit of the risk concern around using cryptocurrency, digital asset type instruments in trade finance, but you know, not moving away from my kind of core focus on financial crime, there's still volatility and risk in using stablecoins. We've seen that with the Terra and Luna case. We've seen that with multiple other cases in terms of assigning reserves to back up stablecoins with large volume. I think banks are increasingly issuing their own stablecoins, and obviously I think from a consumer perspective, there's greater trust in banks than non-banks around issuing these sorts of currencies potentially. But I'm sure there will be cases where even bank issued stablecoins are problematic and may fail. So I think we can't completely dismiss the potential volatility and risk in using stablecoins. I think from a counterparty risk perspective more broadly, there's some super interesting trends deeper around the ability to better identify who, from a financial institution perspective, your customer's customer maybe, your customer's supplier, using, concurrent technologies, artificial intelligence, machine learning, billions of data points through a large language model, passing vast amounts of adverse media as much easier than it used to be, having legal entity identifiers assigned to counterparties, all that data which is available now for institutions without the old troubles of having to kind of pass all that data or kind of make sense of it, or the expense of having to do so. So I think the insight into counterparty risk is now a lot clearer and more straightforward than it used to be. And we've seen technologies which can identify a counterparty immediately, assign a risk score to the counterparty with full explainability coming out of a machine learning model, which really assists in terms of that broader risk assessment at a transaction and at a customer level.
Yeah,
Right.
absolutely. And just to add on to that, to Ben's point, where we're talking about there's a risk score generated, but you're not only processing all of this data, we have the systems and the technology, whether it's in-house, vendor, combination, whatever it may be, you're actually able to use the data. You're not just accepting it and passing it on. It becomes an asset, right? So your data assets become richer, you're able to use them, and you're able to actually iterate and evolve faster.
And that's a great example of where stablecoins have already improved settlement efficiency and transparency, right? In these trade transactions. Are there any other examples you guys can think of off the top of your heads? And if not, I'm putting you on the spot. So
Yeah.
if not, it's okay.
All
I think for
good.
me, looking at the industry broadly, it feels like there's experimentation and pilots and multiple use cases in the sort of payment space with digital assets, which are still kind of relatively early days, which I think is understandable given where we are, but also interesting to think about that time horizon that I mentioned at the start of the session in terms of how long blockchain has been around. What I also find exciting is the speed at which the industry can move now, bank and fintech collaboration, and even the kind of the number and depth and breadth of conversations we're having about it. I think it for collaboration around FinCrime, we've seen we put together a couple of papers within 4 to 6 weeks. We're looking at kind of emerging trends, and putting opinion pieces out there, holding events, promoting directions, doing advocacy, which I think is a key focus of the industry forums around these sorts of topics, as well as other current issues, tariff evasion. We mentioned counterparty risk, use of generative AI. So it really feels like the industry broadly, inclusive of corporates, exporters, importers, non-banks, technology partners, is sort of collectively being able to move these conversations on a lot more quickly than they used to.
Absolutely. I think that maybe even the same entities are now thinking about their new use cases, though, or maybe there's a new geography that they can get into that would have been, quite arduous before, or a business that was thinking, well, I can actually expand my clientele because I have access to USDC and I can do it this way now, or something like this. So it's opening up that optionality, not just for financial institutions, but also for clients, right? And so we have to come together to support that.
Right. Thank you. Let's switch our focus a little bit and talk about tokenization of trade finance assets. So tokenization promises to make traditionally illiquid instruments investable and traceable. What specific trade finance assets are most suitable for tokenization? Ben, do you want to start us off?
Sure, thanks. So I feel like large transactions under export letters of credit in particular, forfeits were probably the first area where banks, financial institutions would distribute risk. And these were often multi-year transactions, and usually in the kind of industrials space, machinery, and often exports out of places like Korea, Japan, Germany. So I think at a transaction level, whether it's under LC or forfeit or otherwise, there's the ability to really improve how those are done even in the project export finance space as well, at a transaction level. So I think that's the sort of first potential where tokenizing a trade finance transaction can really open up, better control, more sources of liquidity, ability to manage that kind of balance sheet and performance risk. Secondly, at a facility level, we've seen syndication of trade finance, lending facilities being very common globally. Certainly, I feel like in the North American market, it was probably the first market really to champion and pioneer multi-bank facilities, agent-led models with execution in the background across a multitude of trade finance products. We saw supply chain finance from a payable standpoint really come on, in the 2000s, 2010s, led by a bank with, often 10, 20 banks participating in the facility. And then the third area, I think, which is not necessarily more recent, but full treatment of a bucket of trade finance assets as a debt instrument, and packaging that debt instrument and having kind of first, second, third tranches, first loss, treating as an issuance, often $1 billion, $2 billion, $3 billion, etc., of self-liquidating trade finance loans, whether they're factoring receivables, payables, etc. Super relevant use case for tokenization, and one where we've seen a massively increased level of activity from the early days in the 90s, 2000s, where banks would kind of dabble with putting trade finance assets into a debt issuance, to now where plenty of banks and non-banks run these big opportunities, and institutional investors are much more aware of the opportunity for investment in trade finance assets than ever before.
Thank you. And you also kind of answered my next question, which was, how might tokenized assets improve access to capital for small and medium enterprises, or even emerging market exporters? So thank you for that. Tiffany, do you have anything to add to this, or should we move on?
I think Ben pretty much covered it, right? And I think it ties nicely to, why we see the increased adoption, and it's all touching each point, right? Of where this is just opening up connectivity and financial options that just didn't exist before, not just for speed, but also for better traceability. Accounting probably made easier for those in the back end, keeping up the ledgers. So yeah, really exciting.
Yeah, and I
Great.
think you said it very well, Tiffany, as well, in terms of that closing of the trade finance gap and
Hmm.
extending liquidity to small and medium-sized enterprises in emerging and exotic markets. With things like USDC, the ability for
Hmm.
lenders and investors to be able to enter those new markets, assess the risk of those ultimate borrowers, using this greater level of transparency and traceability is something I certainly see increasing, and really potentially beneficial for
Absolutely.
entrepreneurs
Yeah.
in those kind of locations.
Yep, absolutely. Um, let's talk a little bit now about compliance and anti-money laundering and financing and terrorist financing, risk management. So basically, overall risk management.
Mhm.
As these innovations accelerate, what new financial crime risks are emerging that you guys are seeing, and how well do existing AML and CFT frameworks address them? Are there compliance or data sharing tools like AI, or blockchain analytics, that can actually help bridge the gap between, the innovation and the oversight?
Mhm.
Tiffany, you want to start us off?
Sure, I can start there. So, as with any new technology, you're going to have bad actors adopt it very quickly, learn how it works, and exploit it out of the gate, right? Which is why I think when, you know, we talked about the first block being minted in 2009, and then for so long, crypto kind of meant bad, right? When you would hear somebody say, "Oh, cryptocurrency," and "Oh, that's the currency of criminals" or
Yeah,
something, right? So that's not it, right? The technology is there; it was just exploited. There's nothing wrong with the technology. So I think we're starting to turn that corner with that. But essentially, the same risks are there, right? So your bad actors are going to see a new methodology that moves money quickly, which means it's ripe for fraud. scams. You'll see the pig butchering scams that are out there, account takeovers, impersonations, that pseudo anonymity, but basically the same way that they would prey on anyone else to execute a scam is going to be essentially the same. Again, just done completely electronically. So you're, again, like I said earlier, those core principles of what is money laundering, what's a sanctions evasion, what's terrorist financing look like, et cetera. You're just going to see it happen quicker and probably just more intricately, right? So it took a lot of effort to physically move cash from one place to another or wait a couple days for a wire. Right now, I can split these transactions out into multiple legs, multiple wallets, and then bring them all back together centrally. So my counterparty risk is going to increase if I'm looking at bad actors. But if I have the right systems and the right detection logic, I can find this with my typologies. So when we look at blockchain analytics tools, AI can help with that machine learning component of what it is. You absolutely should employ that to your use case. So if you're following from fiat to blockchain transactions and back to fiat, you have to merge those two. You can't just have one or the other. And also looking at multiple blockchain analytics tools. The way the blockchain works is all of the distributed ledger technology, and it's connected to the various nodes and who's hosting those nodes. So you're going to have to kind of try to cover the internet, which is a really big task, but there are multiple different ways to do that and then bring it all back together. So as long as you're innovating your product offerings as you innovate your controls, this is the most important part. Those two have to be innovated with together in order to find that. So don't rewrite the entire AML playbook. You don't need to do that. You just need to update the typologies and how those original core foundations of anti-money laundering are just manifesting differently in your tokenized assets and your DLT transactions.
Great. Ben, do you want to talk a little bit about risk mitigation?
Yeah, no, I think Tiffany
Add-on.
was super interesting in terms of the way to approach this space from a fin crime risk management perspective. I think it's important to note that even with that early hysteria about the risk around cryptocurrencies, the data showed that all the way through from Genesis to now, um, actual criminal activity on chain has always been less than 1%. And obviously there's different interpretations of the data and so on and so forth. But in general, the actual risk has been overstated. But it is there, and the dark web is real, and there are specific instruments that do cater to complete anonymity and promotion in weapons trading, human trafficking, and terrorist financing. I think for me the sort of two big themes are laundering the proceeds of crime and fraud, and certainly data-wise, fraud has been by far the biggest financial crime risk within the digital asset community. I think from a money laundering perspective, excluding some digital assets which are specifically catering to the criminal community, I think the ability to identify proceeds of crime via analytics actually assists in terms of the visibility into detecting criminal activity. I mean, if anyone on the call hasn't attended a Chainalysis forum or Elliptic or CipherTrace, I mean, some of the following wallet to wallet and ability to collaborate with law enforcement or the IRS or similar to identify the laundering of proceeds of crime and arrest criminals is incredible. I mean, this is really, really doing good in terms of identifying actual crime. And some of the, I've been lucky enough to see many of the sort of undercover FBI cases as well firsthand, where they've taken over mixers or fiat to crypto conversion and vice versa, and run them for a while to identify the kind of source of narco activity or similar. So I think genuinely, it enhances the ability to detect money laundering by the use of digital assets. Fraud then is a sort of is the next big theme where I think you know, again, thinking of the big cases and plenty of headlines recently around fraud in trade finance. These are not necessarily representative of broader systemic risks around using receivables finance, supply chain finance, documentary trade finance, etc. What maybe is new is the participation of investment banks and asset managers in those transactions, plus non-banks. And I think the movement onto DLT and the use of digital assets will genuinely bring a benefit from a control, visibility, transparency, traceability perspective that we've talked about. So there is, a legitimate story around better risk of fraud, better management of fraud risk by using digital assets.
Okay. Well, thanks, Ben. Do you see potential for global standards or public-private frameworks to emerge around this tokenized trade finance? Similar to what ISO 20022 has done for, cross-border payments.
Yeah, for sure. I think that kind of managing that, sort of instantaneous exchange of value for documents or value for data representing the underlying trade is where international institutions and rule sets and frameworks can really assist. Like I mentioned earlier, there's already a pretty good correlation between the sort of electronic, I didn't mention UCC, but UCC as well as UCP 600 as well as EUCP, and various pieces of legislation that I also mentioned. There's already a pretty strong correlation. I think building on that, you've then got a potential role for the ICC around best practice in digital assets in trade finance. You've got sort of adoption and promotion from a development bank perspective, particularly when it comes to promotion in the in emerging markets and closing the SME gap. So I think, and then maybe finally from a public-private perspective around promotion of innovation and the ability to mitigate risk. There's certainly a role, and we've seen, here in the US over many years, collaboration between law enforcement and banking regulators aiming at promoting innovation and greater participation from the financial services sector would be very beneficial, as well as the sort of international bodies. I haven't mentioned FATF, the Egmont Group, Wolfsburg. I think there's certainly a key role that these groups can play in promoting the use of digital assets in trade and trade finance.
No, absolutely. Please, Tiffany, go ahead.
Yeah, I absolutely agree with that. I think it's paramount that those partnerships continue because we don't want there to be any nuance around this or any sort of anything that could be misunderstood, right? We want it to be more uniform. We want it to be very clear. Again, not trying to bog down the technology itself, but to provide that clarity and again, solidify that trust in these transactions, and then having that unification across private public sector is a key to this.
Good. No, thank you. As we're looking ahead and we develop a strategic vision, what's the one evolving innovation or regulatory breakthrough that could unlock mainstream adoption of digital assets in trade finance? Tiffany, you want to start us off?
Oh, the one thing could go on for a couple, but the one thing that could unlock this, I think, honestly, is when we don't have the regulatory arbitrage. That's the one breakthrough that I'm looking for. Just as we're looking to solve client needs, client wants, and then trying to, promote the global connectivity. If I've got 6 countries out of 50 that have, well, you can do digital, but only this way, or you can do stable coins, but you can't do crypto. And then how do they define crypto? And so that makes it a little bit tricky to offer products uniformly. So that would be that would unlock mainstream adoption. From my perspective, is being able to serve global clients holistically without any sort of nuance.
Okay. Wonderful. Ben, any insight on that?
Yeah, I think difficult question. Maybe without kind of it being too much of a cop out. Practical collaboration, I think for
Mm,
me is the potential big breakthrough. You know, the technology exists today in the DLT and digital asset space. Generative AI and LLMs in particular in the trade finance space are a game changer. I think AI more broadly, established machine learning techniques, the potential for quantum computing. The technology is there today to really transform how we operate as practitioners and how we support
mhm,
industry and clients and our mission to catch the bad guys. Um, so it's really around, the reason I said practical collaboration is we don't need to, be over ambitious. We don't need to kind of set standards and try and, recreate what, credit cards did in the 80s, let's say, with every industry participate, collaborating in every single, big game changing initiative. We can focus on using those amazing technologies in specific use cases within organizations, within geographies, within industries, and we don't need to worry about digital islands because the power of integration and APIs and the gradual progression towards greater levels of data sharing through other technologies like confidential cloud computing, with the support of sovereign governments and regulators, I think is there. So um, practical collaboration within industries, between banks and fintechs, between industry players, I think is really where I see a huge potential.
Right.
sure.
Well, if we reconvene in 5 years, what will have changed the most? The technology, the regulation, or the mindset of market participants? Tiffany, why don't you start us off?
So for that one, I think the tech is going to change faster than anything, right? That's usually how we see it. The tech will have changed the most. Mindsets will have shifted, right? Will it be up to the next level of tech evolution, mainstream? Maybe not, but the mindsets have shifted. This will become the norm. And then as everything, right? I think regulation kind of follows the evolution and the adoption, but I think they will not be as far behind each other as they have historically been. Basically, if you put your phone down at this point, you've missed the next headline of what's developing in this space. So I think all three will be off to the races in the next 5 years.
All right. Ben, what about you? What do you think?
Yeah, I think for me it's the mindset of market participants. Um, so and if we think about the market as its true breadth and depth across financial institutions and non-banks of all sizes, I think that's where we'll see the biggest change. I don't, like I said just now, I think that, much of the technology exists. Don't disagree, Tiffany. I think it will move super quickly, but in terms of the kind of base technologies, they're there and available now. And I think I don't necessarily see any huge regulatory blockers aside from maybe data sharing across financial institutions, which I hope will change relatively quickly. But for me, it's more kind of concern in market participants around potential regulatory backlash rather than actual regulations
Mm,
necessarily
Yeah.
holding market
sure.
participants back.
Great. Well, we have 4 minutes left, and I don't want to waste this time. So I'm going to open it up to the audience in case they have any questions, around digital assets, and trade finance. Please use the Q&A functionality to ask any questions. Anything out there? Okay. I guess we were just that thorough. So it's wonderful.
It's all too scary and new, Deeper. I think that's
Right? Everybody's trying to digest all the information. No, this has been a wonderful session. Thank you both, Ben and Tiffany, for coming out and taking the time to, take us through digital assets and how they relate to trade finance. And that's always, I feel like trade finance, for those of us who are not on the trade finance side, and that includes me. I'm a payments and financial crimes gal. For trade finance is this mysterious thing, and digital assets of course are emerging now, and this topic was of real interest to me because how do digital assets relate to trade finance? I think you guys laid out the information wonderfully and easy to understand. And if we do get any questions or anything later, I'll definitely pass them on to you. But thank you so much for your time. And it was wonderful having you. Thank you.